I'm going to tell you something that will sound insane to most people. You don't need 50 stocks to retire wealthy. You don't need 30. You don't even need 10. If you really know what you're doing, 3 is enough. Maybe even 1. And I'm not talking about getting lucky. I'm talking about thinking clearly, working hard, and having the discipline to sit still when you found something wonderful. Now, before you dismiss this as the ramblings of an old man, let me tell you who's been teaching the opposite. Every business school in America, every financial advisor with a certification, every fund manager who needs to justify their fees. They'll tell you that concentration is reckless, that diversification is the only prudent path, that you need exposure to multiple sectors and geographies and asset classes. And you know what? For most people, they're right, but not for the reason they think. Let me take you back to when I was young, when Warren and I were just starting to figure this out. It was the early 1960 seconds. It'd been practicing law, making a good living, but it started investing on the side. And I noticed something that bothered me. It'd see these investors, smart people, doctors and lawyers and engineers, and they'd have portfolios with 30, 40, 50 positions. And when you'd ask them about any particular holding, they couldn't tell you much. They knew the ticker symbol. They knew what sector it was in. They might remember what the analyst said about it, but they didn't really understand the business. And I thought, this is madness. How can you own something if you don't understand it? How can you know if the price makes sense if you don't know what you're buying? It's like going to a foreign country where you don't speak the language and trying to negotiate a real estate deal. You might get lucky, but you're probably going to get taken advantage of. And that's what was happening to these people. They were buying stocks they didn't understand because some expert told them to diversify. Warren and I took a different approach. We said, let's find businesses we can actually understand. Simple businesses with clear economics. And let's only buy them when the price makes sense. And once we own them, let's not fiddle with them unless something fundamental changes. That was the whole strategy. It sounds simple because it is simple, but simple doesn't mean easy. Let me tell you about a man I knew. He wasn't famous. He wasn't rich when he started. He was a dentist in a small town. And in his early 30s, he bought stock in a local bank. Not because it was glamorous or exciting. He bought it because he understood it. He knew the management. He knew where their deposits came from. He knew who their borrowers were. He understood the risks and the opportunities better than anyone outside that town possibly could. And he held that stock for 40 years. 40 years. Never sold a share. Just collected the dividends and reinvested them. And you know what happened. He retired wealthy. Not because he was a genius, because he understood one thing deeply and he had the patience to let it compound. Now, compare that to the typical investor today. They open their trading app. They see that some technology company is up 20% this month. They don't know what the company does. They don't know how it makes money. They don't know who the competition is or what could go wrong. But everyone's talking about it, so they buy some. Then they see a pharmaceutical stock that an analyst recommended. They buy some of that too. Then maybe some retail, some energy, some international exposure, because their advisor said they need geographic diversification. Before long, they've got 30 positions, and they couldn't explain even one of them to their spouse at dinner. That's not investing, that's collecting, like a child collecting baseball cards, except these cards cost real money, and most of them are going to be worthless. You know what the paradox is? The more stocks you own, the less you know, and the less you know, the more you think you need to own. It becomes this vicious cycle. You don't understand what you own, so you feel insecure, so you buy more things to spread the risk, which means you understand even less, which makes you more insecure. It never ends, and at the end of 30 years, you've got a portfolio full of mediocrity and returns that barely beat inflation after taxes and fees. Here's what nobody wants to hear. Most businesses aren't worth owning at any price. They're in competitive industries with low margins. They're run by mediocre management. They have no competitive advantages. They're just ordinary companies doing ordinary things. And there's nothing wrong with that from a societal perspective. But from an investment perspective, you don't want to own them. You want the exceptional businesses, the ones with durable competitive advantages, the ones with honest, capable management, the ones that will be worth significantly more in 10 years than they are today. And those businesses are rare, very rare. I remember when we bought See's Candies. This was back in 1972. Warren and I looked at the business and we saw something most people missed. Yes, they sold chocolate, but that's not what they were really selling. They were selling nostalgia. They were selling love. A husband buys his wife a box of See's on Valentine's Day, not because it's the best chocolate in the world, but because that's what his father bought his mother and his grandfather before that. That's not a business. That's a tradition. And traditions don't get disrupted by new competitors or changing tastes. Traditions persist. That's a moat that competitors simply cannot cross. Now, a financial analyst would look at See's and say, well, it's a candy company. You need to diversify. You should also own some beverage companies and maybe some snack food companies to balance your consumer goods exposure. And that analyst would completely miss the point. See's wasn't a candy company in the same way Coca-Cola wasn't a beverage company. They were brands with emotional resonance. They owned space in people's hearts. You can't balance sheet that. You can't diversify that. You either understand it or you don't. Let me tell you what happened in the 1,980 seconds with Coca-Cola. Everyone knew it was a great business. I mean everyone. It had been around for 100 years. It was sold in every corner of the world. It had incredible brand value, and at one point in the 80s it was trading at a price that was absolutely ridiculous, far too cheap for what you were getting. So what did Warren do? He backed up the truck. He bought as much as he could, and people said, Warren, you already own consumer goods, stocks. You need to diversify. You're overweighted in beverages. And he said, essentially, I don't care about my allocation to beverages. I care about buying wonderful businesses at attractive prices. And when I find one, I'm going to buy a lot of it. You know how much money that decision made for Berkshire. Billions. Not millions. Billions with a B. And it happened because Warren ignored the conventional wisdom about diversification. He understood that when you find something truly exceptional at an attractive price, you don't check your portfolio allocation. You don't worry about having too much in one sector. You buy as much as you can responsibly own. That's not reckless. That's rational. But it requires conviction. And conviction requires knowledge. And knowledge requires work that most people simply will not do. I've been watching this circus for 7 decades now. Every year, there's a fresh batch of business school graduates who come out thinking they've learned something profound. They've learned about beta and alpha and the efficient frontier and modern portfolio theory. They've learned how to build these elaborate models with Greek letters and complex formulas. And the first thing they do when they get a job, they build a portfolio of 40 stocks they couldn't explain to their own mother. That's not education. That's organized confusion. Let me ask you something. If you were going to get surgery, would you want a doctor who's mediocre at 40 different procedures, or a doctor who's truly excellent at 3 procedures? Of course you'd want the specialist. You'd want someone who's done that operation 1,000 times, who knows every possible complication, who could do it in their sleep. But somehow in investing, we've convinced ourselves that being mediocre at everything is better than being excellent at a few things. It's backwards. It's completely backwards. The financial industry loves this, by the way. They love complexity. They love diversification. You know why. Because every layer of complexity is another fee they can charge. They build these elaborate portfolios with international exposure and emerging markets and alternative assets and derivatives and hedging strategies. And then they charge you 2% a year to manage your confusion. It's a beautiful business model for them. It's a terrible deal for you. Warren and I have always believed the opposite. We think simplicity is the ultimate sophistication. We look for businesses that are so obvious, so simple, that an intelligent 12-year-old could understand them. And then we pay a fair price and we hold them. That's it. That's the whole strategy. But people can't accept that it's that simple. They think we're hiding something. They think there must be some secret sauce we're not sharing. There isn't. We read, we think, we decide, we wait. That's the whole thing. Now, let me tell you what's going to happen in the next few years, probably around 2025, 2026. We've had this extraordinary period of cheap money, interest rates near zero for over a decade. And when money is free, people do stupid things. They overpay for assets, they chase returns, they take on leverage, they buy businesses they don't understand because prices are going up, and they convince themselves that this time is different, that the old rules don't apply anymore. But the rules always apply. Gravity always works. And when this thing corrects, and it will correct, a lot of people are going to get hurt. The ones who will survive, the ones who will prosper, will be the ones who've been careful, the ones who stayed within their circle of competence, the ones who haven't used leverage, the ones who actually understand what they own. Because when prices drop 30 or 40% and everyone's panicking, you need to know whether what you own is a disaster or an opportunity. And if you are diversified across 50 stocks you don't really understand, you won't be able to tell the difference. You'll panic with everyone else, you'll sell at the bottom, and you'll miss the opportunity of a lifetime. I remember 1973 and 1974. The market dropped nearly 50%. It was brutal. People thought the world was ending. Companies that had been darlings just a few years earlier were trading for nothing. And every day my phone would ring. People asking, should I sell? Shouldn't we get out? This is a disaster. And I'd ask them, has anything fundamental changed about your businesses? Are they still making money? Do they still have their competitive advantages? Are the customers still buying their products? And usually the answer was, yes, nothing fundamental has changed, just the price. And it'd say, then why would you sell? if nothing's changed except the price went down, that's not a reason to sell. That's a reason to buy more if you have cash. But here's the thing. I could only think that clearly because I understood what I owned. It'd done the work. It read the annual reports. It studied the competitors. It talked to the management. It thought about the business model and the risks and the opportunities. I knew those businesses almost as well as the people running them. That knowledge gave me the emotional stability to sit still when everyone else was losing their minds. That's the real value of concentration. It's not that it necessarily gives you better returns, though it often does. It's that it gives you the knowledge to be rational when rationality is most valuable. Let me tell you a story about newspapers. Back in the 70s, we bought stock in a newspaper. Small city, good paper, no competition. We understood the economics perfectly. Local businesses needed to advertise. Readers wanted local news. The barriers to entry were enormous. Nobody was going to start a competing newspaper. The cash flows were predictable and growing. It was a wonderful business. So we bought a significant position and we held it for 30 years. 30 years. During that time, there were recessions, there were wars, there were market crashes, there were new technologies, there was constant change and chaos in the world. And every few years, someone would ask, "Aren't you worried about your newspaper? Shouldn't you diversify? What if something happens?" And we'd say, "What specifically are you worried about? Has the business model changed? Do local businesses not need to advertise anymore? Do people not want local news?" And the answer was always no. Nothing fundamental has changed. So we held. And that position made us an enormous amount of money over those 3 decades. Now, contrast that with the typical investor. They would have owned that newspaper as part of a portfolio of 40 stocks. Maybe it was 3% of their holdings. When it went up, they wouldn't have made much money because it was too small a position. When it went down temporarily, they might have sold it to rebalance or because some analysts downgraded the media sector. They would have been so busy managing their forest of holdings that they completely missed the value of that one exceptional tree. That's the cost of diversification that nobody talks about. It's not just that you don't make as much money on your winners. It's that you don't even recognize which ones are winners because you're not paying attention. You know what I find amusing? These people who brag about being diversified across 12 sectors and 30 countries, they think that's sophistication. To me, it's just geography. You haven't reduced your risk. You've spread your ignorance over a wider area. Congratulations. You're confused in multiple languages. Now you don't understand what's happening in your domestic holdings, and you don't understand what's happening in your international holdings either. That's not risk management. That's just more risk. I've been asked 1,000 times over the years, "Charlie, how many stocks should someone own?" And it's the wrong question. The right question is, how many businesses can you truly understand? For most people, that number is somewhere between 1 and 5. Not 50, not 500, maybe 5. And if you can't find 5, if you can't find 3, if you can't even find one that you truly understand, then you shouldn't be picking individual stocks at all. You should buy an index fund and go live your life. There's no shame in that. That's honest. That's smart. What's not smart is pretending you understand things you don't. The academic world, they've built this entire theory around diversification and efficient markets. They teach it as fact. But It's based on a fundamental misunderstanding of what risk actually is. They think risk is volatility. They think risk is price fluctuation. So they build these models that try to minimize volatility through diversification. But that's not what risk is. Risk is the permanent loss of capital. Risk is buying something you don't understand and having it go to zero. Volatility is just noise. It's opportunity if you know what you're doing. I'll give you an example. Let's say you deeply understand three businesses. You know them inside and out. You know how they make money. You know what threatens them. You know what opportunities they have. And you own them in your portfolio, each one about 30%. Now, let's say the market drops and these stocks drop 40% with everything else. Are you worried? No, because you know that nothing fundamental has changed. You know those businesses are still valuable. You might even be excited because now you can buy more at a better price if you have cash available. That's not risky. That's rational. Now, let's say instead you own 50 stocks and you sort of understand them, but not really. And the market drops and they all drop 40%. Are you worried? Absolutely. Because you don't know which ones are disasters and which ones are opportunities. You don't know if you should sell or hold or buy more. So what do most people do? They panic. They sell everything. They lock in their losses. And then when things recover, they buy back in at higher prices. That's risky. That's how people destroy wealth. Here's something else nobody wants to hear. The role of luck. People don't like to admit that luck plays a part in investing success. They want to believe it's all skill, all intelligence, all hard work. But that's not true. Warren and I have been lucky in many ways. We were born in the right country at the right time. We had the right temperaments for this business. We found each other. That's luck. But here's the key. We positioned ourselves to take advantage of luck when it arrived. We had capital available. We had the knowledge to recognize opportunity. We had the courage to act. Most people fail at one of those three things. You know what's going to separate the successful from the unsuccessful in the next market downturn, whenever it comes. It won't be who has the most sophisticated portfolio. It won't be who has the best diversification. It'll be who has the knowledge to stay rational when everyone else is panicking. It'll be who has the cash to buy when others are forced to sell. It'll be who has the patience to hold through the chaos. And you can only have those things if you truly understand what you own. You can't fake it. You can't diversify your way into it. You have to do the work. I met a young investor recently. He was proud of his portfolio. He had diversified across technology and healthcare and financials and consumer goods and energy and industrials. He had international exposure and emerging markets and some commodities. He thought he'd done everything right. So I asked him, "Tell me about your largest holding. What does the company do?" He started explaining, and after about 30 seconds, he was already getting vague. He was using buzzwords and industry jargon. I said, "Stop. Could you explain this business to your grandmother? Could you explain how they make money, who their customers are, what threatens them, why they're better than their competitors?" He couldn't, and that was his largest holding. The thing he'd bet the most money on. He couldn't even explain it simply. That's the state of modern investing. People own things they don't understand because they think diversification makes it okay to be ignorant about individual holdings. As long as you own enough stuff, it doesn't matter if you don't know what any of it does. That's the theory anyway. But it's wrong. It's completely wrong. Because in a crisis, and there's always eventually a crisis, that ignorance will kill you. Let me tell you about the best investment I ever made. It wasn't a stock. It was time. Time spent reading. Time spent thinking. Time spent talking to people who understood businesses better than I did. I've probably read thousands of annual reports in my life. Thousands. And you know what I learned? Most businesses are mediocre. Most management teams are mediocre. Most investment opportunities are mediocre. The truly exceptional ones are rare. So rare that if you find one or two or three in a lifetime, you've done extraordinarily well. And when you find them, you should bet accordingly. You shouldn't dilute that exceptional opportunity with 47 mediocre ones. Here's what I think is going to happen to most investors over the next decade. They're going to continue doing what they've always done. They're going to diversify across dozens of holdings. They're going to pay fees to advisors and fund managers. They're going to trade too frequently. They're going to chase performance. They're going to panic during downturns and get greedy during bubbles. And at the end of it all, they're going to have returns that barely beat inflation, if they beat it at all. And they'll wonder why, despite all their activity, despite all their sophistication, they never got wealthy. The answer is simple. They confused motion with progress. They confused complexity with wisdom. They confused diversification with understanding. Meanwhile, a small number of people will do something different. They'll find 3 businesses they can actually understand. They'll pay reasonable prices. They'll hold for decades. They'll ignore the noise. They'll stay rational during chaos. They'll be patient and they'll get rich, not because they're smarter, because they're more disciplined, because they understand that in investing, less is often more. Fewer holdings, fewer decisions, fewer mistakes, but better decisions. Decisions based on real knowledge rather than portfolio theory. You know what's funny? If I'd told people in 1965 when we bought Berkshire that we were going to build an enormous fortune, primarily from 10 or 15 key positions over the next 6 decades, they would have called me crazy. They would have said, "That's too risky. You need to diversify. You need exposure to multiple sectors. You need international holdings. You need to rebalance regularly." We ignored all of that. We did the opposite, and it worked. Not because we were lucky, though we were, but because the fundamental principle was sound. Own exceptional businesses, pay fair prices, hold them. Simple, but not easy. The hardest part isn't finding good businesses. It isn't even buying them. The hardest part is doing nothing afterward. Just sitting there while everyone around you is busy, while they're trading and rebalancing and adjusting and optimizing, while they're chasing the hot stock of the month. You're just sitting there with your 3 businesses, collecting dividends, reading annual reports, and waiting. That takes a special temperament. Most people don't have it. They need activity like they need oxygen. And that need for activity destroys returns more surely than any other single factor. It'll tell you something that will probably upset people. The democratization of investing through apps and online brokers has been a disaster for most people. Not because there's anything wrong with the technology, but because it's given millions of people access to something they're not equipped to do well. Investing requires patience, discipline, emotional stability, and the ability to think independently. Most people don't have all those qualities. That's not an insult. It's just reality. And before these apps existed, those people would have hired an advisor or bought mutual funds or just saved money in a bank account. They wouldn't have been day trading stocks they don't understand. But now they can, and they do, and they lose money. Access isn't the same as capability. If you're a doctor or a teacher or an engineer, and you don't have the time or temperament or interest to study businesses deeply, there's a simple solution. Buy an index fund that tracks the broad market. You'll get average returns, which over long periods are actually pretty good. You'll pay minimal fees. You won't have to do any work. You won't have to make any decisions. And you'll almost certainly do better than you would trying to pick stocks you don't understand. That's not failure. That's wisdom. The failure is pretending you're something you're not and losing money proving it. But if you are going to pick individual stocks, if you're going to try to beat the market, then do it right. Find businesses you can understand completely. Study them until you know them better than almost anyone. Pay fair prices. Buy enough that it matters when you're right. And then have the courage and discipline to do nothing for years, maybe decades. Ignore the noise, ignore the market movements, ignore what other people are doing. Just focus on whether the fundamentals of your businesses have changed. If they haven't, hold. If they have, sell. It's simple, but it's not easy. As I look at what's happening now, in late 2023, I see a lot of parallels to periods that came before market disruptions. Not exactly the same. It's never exactly the same, but similar. Cheap money for too long, asset prices that don't make sense, speculation masquerading as investing, people buying things they don't understand because prices are going up. This won't end well. It never does. But I don't know when it will end or how bad it will be. Nobody does, and anyone who tells you they know is lying. What I do know is this: when it ends, when the correction comes, the people with concentrated portfolios of businesses they truly understand will survive and prosper. The people with scattered portfolios of things they sort of understand will panic and suffer. That's always how it works. Knowledge and discipline beat diversification and activity. They always have, and they always will. So here's my advice, for what it's worth, from an old man who's seen a lot of cycles. Figure out what you understand. Be honest about it. Don't fool yourself. If you understand 3 businesses, focus on those. If you can't find 3 you understand, buy an index fund. But whatever you do, don't pretend that owning 50 things you don't understand is safer than owning 3 things you do. That's the lie that's been told for decades, and it's cost people billions in lost opportunity. The path to wealth isn't complicated. Find quality. Pay fair prices. Hold. Ignore noise. Be patient. That's it. Everything else is just commentary.